Welcome back to Your Finance TV. It's Friday, so we get to speak with Jay Pelosky to go over his weekly musings and go through what's been happening in the market this week. Welcome back, Jay.
All right, Scott, good to see you. It seems like I just saw you a few days ago.
Listen, Christmas doesn't usually come in April, but we got twice in 1 week, so it's a great thing.
Exactly.
All right, before we jump into the musings, don't forget to click on that subscribe button below. Lots of people are joining up and listening to all the musings that we have and all the insights that we have on Your Finance TV from people like Jay. So make sure you click on there and the like buttons. All right, Jay, the title for your musings this week is Iron Sharpens Iron. Now, usually I've got some sort of like punchline that goes behind it, but this week I'm stumped. All right, run me through what Iron Sharpens Iron is really getting to in this.
Well, Scott, I'm a Duke guy and a Duke football guy. So it actually comes from, believe it or not, a social media post by one of the offensive linemen earlier this year when he welcomed an incoming transfer offensive lineman with the comment, "Iron sharpens iron." So in other words, I did a little research, and when you go back in history, that the phrase actually extends back to biblical times. It's one of the proverbs, "Iron sharpens iron." So the idea is that, if you have one iron blade by itself, it gets dull. If you have two iron blades, or let's say two offensive tackles, or number one offensive tackle versus number one defensive tackle, you get better by working together, right? So it's this idea of iron sharpens iron, which I love. And of course, I always love it when the big fellas, lead the discussion. And of course, it's only at Duke that you're going to see people, putting together phrases that even an erudite guy like you has not heard of before.
All right. So listen, we've got the Duke reference, the biblical reference. How does this relate to the markets? Like, give me some examples in the markets of iron sharpening iron.
Markets? What? I thought we were just talking about football, baby. Yeah. Okay. So there are multiple examples, right? So that's what we really do want to talk about. And a good one is, the IMF and the World Bank came out with their updates, their forecasts. They have their annual meeting this week in DC. And they are very, kind of negative on global growth. You have Larry Summers, on the other hand, well-known economist, former, I believe, Treasury Secretary, being more constructive on growth. The one I really like is, so that's a policy kind of debate that's going on. In the markets, the one I really like, I think really gets to the essence of the issue, is that you have U.S. sell-side equity analysts forecasting a pickup in earnings growth at the end of this year, second half of this year into 2024, at the same time as you have fixed income investors betting on rate cuts in a recession in the second half of the year. So that's iron sharpening iron, right? Sell-side equity analysts, fixed income investors. Equity analysts clearly don't see a recession. They're forecasting earnings to trough this quarter, Q1, -8 year over year, then -4 year over year, Q2, flat Q3, +8 Q4, +12 Q1 2024. That's an accelerating earnings path, clearly inconsistent with recession. On the other hand, you got the fixed income guys betting on recession, and you can see that when you look at the Fed funds futures rate, saying that the Fed funds is going to be at 4.3% at the end of this year versus 5% today. So clearly, 70 basis points of cuts is the expectation of a recession. There's also, so that's a real big one. And then one or two others to mention quickly is the trading range that the S&P has been in, really now going back about a year, 240 days and counting, where the S&P has been within 5% or so of that 4,000 level. And so that typical trading range extends to about 255 days and is typically broken by the Fed making a move. So we're getting close to that. And then you have issues like Asian growth accelerating versus US and European growth decelerating. And to kind of like put it all together, I saw something in FinTwit, top-down charts put out a record-breaking index level between their bullish technicals and bearish fundamentals. So you really do have kind of coursing through the economy, the policy space, and the market space, this issue of, you know, coming to a head. We have iron sharpening iron. Which way is it going to pan out?
Okay, so there's a lot of events that have come through, as you mentioned, but what is the TPW advisory take in all these events then? What does it all mean when it's all put together?
Well, I actually forgot one thing. So before I talk about what we think, one more data point, and that is from the IMF World Bank meetings, where I got a call yesterday from a buddy of mine, you know, fellow market professional, been going to these meetings for years. And he said the money quote was that he has never seen such bearishness in 30 years of attending those meetings. Wow. And so you recall that last month we wrote about fear, uncertainty, and doubt, and look behind the curtain in our monthly, right? Arguing that this fear, that this FUD, fear, uncertainty, and doubt, is masking some pretty good stuff unfolding behind the curtain. So my buddy's quote there really kind of encapsulates things for me. I just think there's just an excessive amount of pessimism directed to the economy in the US in particular, but also globally, as shown by those IMF and World Bank forecasts, and then manifested by my buddy's quote. He went on further to note that there was a survey done in attendance, so folks at the conference, about 300, all global, you know, economic type people, and 85% of them expected a recession in the next 12 months. So I think that's, you know, that mindset is clearly in the mentality and priced into the bond market, which prices it in, therefore, kind of to the equity market through the tech outperformance, and really sets up the debate about where we're going to go. So that leads us into, you know, into TPW. And our view is that this expectation of a recession and a period of slow growth, kind of going back to the pre-COVID low inflation, low growth world, which is the mindset of the fixed income market, as well as the IMF and the World Bank. We totally disagree. We take the other side, and we believe that there are multiple forces unfolding, right? The central bank's acceptance of a slightly higher inflation rate, which we believe will take place over the next year or so. The return of US industrial policy after a 70-year absence. The integration in Europe around defense, climate, energy, etc. Japan moving off yield curve control, and China accelerating its growth through domestic demand stimulation. These are the things that we're focused on, and which we see as marking, you know, a much more attractive environment, one where the US does not go into recession, and one where the global economy is actually on the cusp of an early cycle acceleration led by Asia, and not the late cycle going into recession, which is how most people view things and how many equity investors in particular are positioned. And even just think about, you know, cash, for example, right? Everyone loves to talk about cash. We should be invested in cash. We've raised cash. We've reduced equities, et cetera, et cetera. Well, lo and behold, in March, okay, when you had SVP fail, when you had Signature Bank get taken over, when you had Credit Suisse forced into a shotgun marriage, in March, cash underperformed. It was worse than equities. It was worse than bonds. It was worse than high yield. It was worse than gold. And yet people love to talk about cash. I mean, it just really doesn't make a whole lot of sense to us. We think that the economy is going to be supported primarily, particularly in the U.S., by the public-private partnership underpinning the industrial policy, and that protects that spending from worries about credit crunch and credit fears and things of that nature, which we feel are overdone and overblown to begin with. And, you know, that's something that we looked at over the last week or so and feel pretty strongly about.
Okay, so listen, and talking about the last week or so, we did your monthly review on Monday. Now, obviously, you go away, you look at the model portfolios, you tweak them, look at some different changes here and there. Can you share any of those changes that happened in the model portfolios?
Sorry, buddy. I mean, you ask me every time. You're very diligent with that question, but you know that the changes themselves are available only to TPW advisory model portfolio clients. And so,
go on, give us a hint.
Well, I can give you a hint, and I'm happy to kind of talk about our process. I encourage your viewers to reach out to us at TPW Advisory. We run 2 model portfolios. One is a global multi-asset. The other is our TPW 20 specific thematic ETFs. And that keeps us very closely tethered to the climate and future tech innovation space in particular. And so one of the things we do as part of our process is we go through all the charts of all our holdings, the broad indices, and other ETFs. We're 100% ETF focused, by the way. Other ETFs that we're considering to perhaps put into the portfolio. And, you know, one of the things we noted is that many of the positions we have in the broad indices are now above where they were pre-SVB. Okay, so not just recovering to where they were when SVB started to roll over, but they're above those levels. And so that suggests clearly that investors really are not worried about the fallout from the bank failures, right? Because if that were the case, then indices and particular ETFs would not be above those levels. So that was something that we noted that was really pretty enlightening to us. The second is looking at credit spreads, right? Credit spreads tend to be an early signal for recession concerns. And so we have high yield positions in our model. We're constructive on credit. And lo and behold, the credit spreads, which ended last year about 4.9%, between high yield and U.S. Treasuries, widened out to over 5.2% with SVB, now 4.7%. So not only recouping the SVB, little spike, but below where they were at the end of last year. Again, no signal that we're going into an imminent recession, right? The recession people are saying this is imminent. It's going to happen next month. Going to happen in Q2, but there's no sign of it. And another point we'd mention on the technical side is looking at the MOVE index, which is the volatility, the VIX really for treasuries, right? And obviously the volatility post SVB was in fixed income most of all. And the MOVE index, for example, blew out all the way above 200, which was the level we saw in the great financial crisis. Today, literally today, this morning, it was back under 120. And so comfortably back in the trading range it's had for the last 6 months or so. So these are all signals to us that this fear of recession is misplaced and that we are likely to avert recession in the US. And there are 2 things we're looking at, and then we'll wrap up on kind of how we expect to see it play out. So the 2 things we're looking at, one is the ag, so Barclays ag. It's just above its 200-day support. We're looking for it to break below support and confirm that we're not going to have a recession as the bond market prices out the rate hikes that are currently priced into the market, right? That's what we would expect to see if the ag falls below support. On the other side of things, we're looking for the Goldman Sachs Commodity Index to break back above the 200-day resistance. It's still below its 200-day support. We tend to agree with the technical analysts who say most of the time you want to be in things that are above their 200-day moving average. We're not technicians, but we believe in technical analysis as being one of the tools in our toolbox. So those are the two things we're looking for. We want to see the ag break down and confirm no recession as rates go up to take out the rate cuts currently priced into the market, and Goldman Sachs commodity to break up and above the 200-day resistance, confirming global growth recovery. And so as we watch this trading range and come to the end of it, typically the Fed is the catalyst to end long S&P trading ranges. We expect the May meeting to be one of those catalysts, right? So May is going to be, whether the Fed raises 25 or not is not important. What's important is that May is going to signal the Fed going on hold. And that is going to continue to lead to dollar weakness, which continues to lead to non-US equity outperformance, which is where one of our big bets are in the portfolio. So we expect the S&P to break out and up, not break down as the bears expect. And when that Fed meeting happens, the bears are going to have to start to make a call, right? We talked about this a couple of weeks ago. If I was bearish, I'd really be worried, because after SVB, what do you expect to see happen that will be more negative for equities, for risk? And like I said, cash underperformed in March with the bank failures, the worst since 2008. So we're looking for the end of this trading range. We're looking for the fear, uncertainty, and doubt curtain to fade away. We're looking for the realization of a U.S. economy that will avert recession, a global economy that's early cycle, a Fed that goes on hold, a dollar that weakens, non-U.S. equity outperforms, bonds underperform, commodities outperform. So we're, no surprise, I can't really give you individual positions, but I can say in our global multi-asset model, we're overweight equities, overweight non-U.S. equity across both developed ex-U.S. and emerging markets. We've built up an overweight in EM over the last 3 or 4 months in the equity space. We're underweight fixed income, deeply underweight, but within that, overweight credit, including emerging market credit, which we like a lot. And we're overweight commodities pretty much across the space, from energy to industrial metals to gold miners, which was a great performer over the last month or so. And that really kind of wraps it up for us, Scott. We look at the bearishness, the most bearish at the IMF World Bank meetings in 30 years. Those are the things we like to pay attention to. Those are the little signals that tell us, wow, it's pretty pervasive out there. The FUD factor, the fear, uncertainty, and doubt factor is pretty high. And iron sharpens iron, as those offensive linemen at Duke know very well. And so we expect to see the iron sharpening iron between the sell-side equity analysts who see earnings acceleration and the fixed income investors who see recession. Iron sharpens iron. Only one of those two is going to be right. We're betting on the equity analysts being right. The S&P breaks out and up, not down.
Well, you can't blame me for trying for the viewers to find out a couple of different names here and there. Like, I've got to keep trying for them, right?
Absolutely. But the best way to do it is not to get a name or two, but to join our service and get all of the names all of the time. That's the way to do it. TPW Advisory, J. Pelosky, Pelosky.com.
Exactly. All right, Jay, listen, thank you very much for this week. You have a fantastic weekend, and I will be talking to you again next week.
All right, Scott. Same to you, buddy. Be well.
And for everyone else out there, good luck investing.